Thinking about getting a new car but not sure how to pay for it? What if I told you that the way you finance your vehicle could make a huge difference in your financial future? In fact, choosing the right payment method could save you thousands of dollars over time. Now stick around, because in the next 10 minutes or so, I'll break down the pros and cons of paying cash, using conventional financing, and leasing a car. All right, let's dive in. Buying a car is a major financial decision, and how you choose to pay for it can have a significant impact on your wallet. Today, we're going to cut through the confusion and focus on three main ways to pay for a car: cash, conventional financing, and leasing. We'll explore the advantages and disadvantages of each method and sprinkle in some money-saving tips along the way. While these next three options will be incredibly helpful in deciding how to pay for your next car, hang in there until the end for a special bonus tip you may not have considered. Let's start with the most straightforward option: paying good old hard cash. The idea here is simple. You pay the full price of the car up front. No financing required. Now, the pros: no monthly payments, of course, no interest charges, immediate ownership, and number four, potential for better negotiation at the dealership. Now, that has changed a little bit. Sometimes that's not real accurate. It used to be you go in with cash and boy, you could get the best deal. That's changed over the years, honestly. They really try to persuade you to finance because they obviously make a lot more money that way. But anyway, the cons are large upfront cost, of course, ties up a significant amount of cash, and the opportunity cost of not investing that money elsewhere, an extremely important point as well. Now, here's a hack. If you're considering paying cash, compare the interest rate you'd pay on a car loan to the potential returns you could earn by investing that money instead, right? Sometimes financing can actually be the smarter financial move. It's what we call arbitrage, for another video. Long story short, that is basically leveraging the difference between a higher interest-bearing account or vehicle versus a lower interest account. And the difference in between is that arbitrage. And there's a lot of fun ways to play with that in the finance world. But anyway, if you thought paying cash was straightforward, wait until you hear about conventional financing. Next up, conventional financing, which means taking out a loan to purchase your car. The pros to this are lower upfront cost and the ability to buy a more expensive car. Got to be careful with that. Potential to build credit and keep cash available for other investments or emergencies. Again, arbitrage plays, right? But the cons: monthly payments, of course. Interest charges increase the total cost of the car, and risk of being underwater on the loan if the car depreciates quickly, which a lot of them do. Here's a hack for securing better loan terms. Shop around for financing before going to the dealership. Credit unions often offer competitive rates, and having a pre-approval in hand can give you negotiating power. Now that is effective. That's what I've always done back in the past. If I financed a vehicle, is I made sure that I was already pre-approved. That way we weren't playing the game in the dealership and all the stuff that they run you through and whatnot. But anyway, if you thought conventional financing was flexible, wait until you see what leasing offers. One of my favorites, actually. But first, if you're new to the channel and you love learning about smart money moves, then smash that subscribe button. Our third option is leasing, which is essentially long-term renting of a vehicle. The pros: lower monthly payments compared to financing. An ability to drive a new car every few years. Woo, I like that. This often includes warranty coverage for the entire lease term. And no worries about selling the car later. You basically take that thing and you drop it back off. Sometimes there's a little fees depending on how hard you drive that thing into the pavement, but for the most part, it's pretty easy. You just get rid of it. Now the cons: mileage restrictions, although negotiable. No ownership at the end of the lease term. Potential fees for excess wear and tear. Generally more expensive in the long run, especially if you decide to purchase the vehicle after the lease. But of course, do not do that. You're going to purchase it, do it in the first place, either pay cash for it or finance it. Don't lease it and decide to keep it. That is very stupid, stupid, stupid. Let me break this down a little bit more, because car leasing can definitely seem complex, but it's essentially based on two main factors: depreciation and interest. Let's break it down. Let's talk about depreciation. This is the difference between the car's value when you start the lease and its expected value at the end of the lease, called the residual value. Here is an example. Let's say you're leasing a $30,000 car for 3 years. The dealership estimates it will be worth $18,000 after 3 years. The depreciation is $12,000, which is basically the $30,000 minus $18,000. Now, let's cover residual value. This is the projected value of the car at the end of the lease. It's usually expressed as a percentage of the original price. And here's an example. In our case, the residual value is $18,000, which is 60% of the original $30,000 price. And finally, let's talk about money factor. This is essentially the interest rate, but it's expressed differently. To convert it to an APR, multiply by 2,400. And here's an example. If the money factor is 0.002, the APR would be 4.8%, or again, 0.002 times 2,400. Now, here's how these factors come together to create your monthly payment. First, monthly depreciation. $12,000 divided by 36 months equals $333.33. And the monthly interest, $30,000 plus $18,000 times 0.002 divided by 12 equals $8. So your base monthly payment would be $333.33 plus $8, which equals $341.33. This is a simplified version, of course. So in reality, you also need to factor in taxes, fees, and down payment or trade-in value. The residual value plays a crucial role in determining your payments. A higher residual value means the car is expected to depreciate less, resulting in lower monthly payments. Here's an example. If the residual was $21,000, 70% instead of 60%, the depreciation would only be $9,000 over 3 years. This would reduce the monthly depreciation to $250, lowering the base payment to $258 plus interest. Whew, holy sheep shite. All that math is giving me a freaking headache, and I know it can be a little convoluted. But also, be aware, manufacturers and dealers sometimes artificially inflate residual values to make lease offers more attractive. This is why you might see surprisingly low payments on some new car leases. And that's not necessarily a bad thing. Sometimes that can get you into a little bit nicer vehicle. But again, always be careful. Temptation, getting yourself underwater, not fun. It's important to note that while a high residual lowers your payments during the lease, it also means you'd have to pay more if you decide to buy the car at the end of the lease term. But don't do that. Don't be stupid, right? We don't do that. You either finance the damn thing or you pay cash for it, but we don't buy that car at the end of the lease term. They're really bending you over, unfortunately, and taking advantage of you. Understanding these concepts can help you negotiate better lease terms and compare offers more effectively. Always read the fine print and consider the total cost of leasing, not just the monthly payment. Here's a hack for those who love driving new cars. If you're set on always having the latest model, leasing can be a cost-effective way to do it, especially if you can write off the payments as a business expense. Again, personally, this is my absolute favorite. Yes, I've financed plenty of vehicles, but I basically just quit doing that because I love to jump into a new vehicle. I don't have to worry about the maintenance, a little bit of stuff. Some of the deals, of course, get the oil changes in there. It just depends on the vehicles that you're looking at. But for the most part, it's, again, you've got a brand new vehicle. It's under warranty after a few years. And of course, you can do them for 3 years, 48 months, longer in some cases. But again, this is what affects the residual. But it's beautiful because you can just turn the damn thing back in and drive off in a new one. Nice, fresh, smelling good, new car smell, right? So that's my personal favorite, but it all depends on you as the individual. Now that we've covered the 3 main options for paying for a car, let's look at a bonus tip that could save you thousands. Here's a bonus tip that combines the best of all worlds. Consider a certified pre-owned vehicle. These are typically 1 to 3 year old cars that have been inspected and reconditioned by the dealership or manufacturer, both, whatever it may be. Why it's brilliant? You get a nearly new car at a significantly lower price than a brand new model. Plus, you avoid the steepest part of the depreciation curve, which of course is when you drive that damn thing off the lot. Of course, you can pay cash if you have it or finance it, or in some cases, you can even lease a used one as well with better terms than a new car. Now, one little bonus on top of that bonus that I just thought about is actually maybe you don't even need a car at all. Depending on how much you drive nowadays with all of the ride shares and whatnot, if you're really wanting to pinch pennies and save that money and invest it in something else, and you can do without a car, maybe you look at the cost of, again, ride shares and weigh out the differences between all the insurance and the maintenance and everything else that you may pay on a car. So that's an option. I know most of us love to have our vehicle when we want it to be able to drive wherever we want to, but that is also something, of course, you can consider. So there you have it. 3 main ways to pay for your next car, plus a bonus strategy to consider. Remember, the best option for you depends on your financial situations, goals, and personal preferences. Now let's recap our key points. Paying cash offers simplicity and savings on interest. Conventional financing provides flexibility and keeps cash available. Leasing allows for a lower payment and frequent upgrades. And of course, with all of these, consider certified pre-owned for value. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more smart money tips. And hey, leave a comment below telling us which car payment method you prefer and why. Thanks for watching, and remember, how you pay for your car can be just as important as which car you choose. Drive safely, and I'll see you in the next video.